Hello Sector Watchers, welcome to the show. This is the 117th episode of Sector Spotlight for Tuesday the 1st of March. I'm recording it on Monday the 28th of February. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. It is the first Tuesday of the month, so that means that the chunk of the time, the biggest chunk of the time, will be eaten up by our monthly charts, our inspection of the monthly charts. That means that we're going to do a very brief rotation, a very brief inspection of the RRGs for asset classes and sectors, and focus on the longer term pictures, the longer term stuff that's going on these completed monthly charts for the asset classes and the sectors. Now, exactly a week ago, we had a very normal, regular sector spotlight on Tuesday, and then on Thursday morning you wake up and everything has changed. And being in Europe, that is a different situation. We haven't seen that in a long time, and I hope that it will be over very soon. But it's very clear that the world has a serious problem right now, and from an investment point of view, we'll just have to wait and see how this is going to play out. I'm glad that the markets and the rotations have given us a little bit of a heads up and fair warning. We were looking at defensive sectors already, but you know, markets always need a catalyst, and it looks as if the events in Ukraine were the catalyst of what we're seeing. Not sure how this is going to work out ultimately, but I am very careful with investments in the stock market right now. Let's get started with Sector Spotlight, mainly looking at monthly charts. As said, we have a very busy and full show with the monthly charts. So for the rotational charts, I'm going to stick with the weeklies and not talk about the daily rotations that took place last week. We're just going to look at the updated weekly rotations for both asset classes and sectors. I've put them side by side here on the screen to save some time. Because I think that the rotations are getting more and more clear, and they're getting the follow through of the rotations that we've already seen under development over the last few weeks. If we start with the asset classes, then it's very clear that the commodity ETFs, that commodities is the asset class to be right now. These tails are very strong and they're expected to continue strongly in the next couple of weeks. Dollar strength, very clearly still there. It lost a little bit of momentum, but it's still moving higher on the RS ratio scale, which means that the dollar strength is still there. Stocks, SPY, is now starting to pick up strength to the downside. It's continuing to rotate through weakening towards lagging, and it's joined by the other risk on asset class, that's real estate, that's now also inside weakening. And you see strength in high yield corporate bonds, government bonds, and to a lesser degree, well, that's rolling over corporate bonds at a very short tail, very close to the benchmark. If we move over to the sectors, then the rotation for the defensive sectors that we've discussed here many times before is becoming very clear right now. Energy is a class on its own, very strong, not necessarily a defensive sector, but it is the leading sector based on everything that's happening in the energy markets right now. And if you look at utilities, healthcare, and staples, they're all inside the leading quadrant. They're losing a little bit of relative momentum over the last week or so, but the general tendency is for these defensive asset classes to remain strong. And maybe even a stronger message is coming from the cyclical sectors, especially from consumer discretionary, which continues further inside into the lagging quadrant. Picked up a little bit of momentum over the last few weeks, but you can see that in the last segment we're now already flattening again. So if you look at this one, you see that it started to moving lower. And if you look at technology, that is still at a negative heading, and it's now crossing over into the lagging quadrant. So that image, that rotation in favor of defense with a clear risk off signal for the general market is still very present. The only other sector that is worth looking at is financials on the back of the rising interest rates, very clearly now into the leading quadrant and holding up very, very well. For the completed monthly charts for the sectors, I want to go over the stock market, the S&P 500, and all individual sectors. I want to give them plenty of attention because I think it's important right now what's going on. So if we start with the S&P 500, then we can see that obviously that uptrend has now been negated. We have a clear lower low than the previous low. Not yet a lower high, but this is the first sign that the uptrend, as we have seen it at least since the start of 2020, but you know, if you wing this a little bit, maybe people say that it had already started in 2009. I think we had a similar situation right here and right here where the uptrend was paused, and that could very well be the case right here, but the uptrend is gone. We have a lower low, and that does not fit with the definition of an uptrend. So that's for the S&P 500. The downside risk, as I see it, is towards the previous high, which I've labeled around here. That is the high that we've seen in the middle of 2020. And that's around 17% from current levels. That's a decent downside risk. If we go over the sectors and we start with the communication services sector, and we see that this has been a very weak sector for quite a while already. Obviously no new high, no new closing high, and the uptrend here was already gone for a while. If we look at where we are right now, that is just over 230, and I think the downside risk here is about 7.5% to the first level and about 17% back to the highs of February 2020. So communication services remains a weak sector, probably one of the weakest or the weakest in the S&P 500. The next one is consumer discretionary. Now here also the blow off, the reversal is very clear. The uptrend is gone. You see that we've dipped below, and I mean a low on a monthly chart for me, that is you know, one of these pivot lows where you have, the easiest definition is when you have a bar, a monthly bar, and then you have another one and a third, and when the low in the middle is lower than the two lows on either side of that bar, that is a low in my opinion. So that's how I label highs and lows roughly. And you can see that we've taken out at least the two previous monthly lows in this consumer discretionary chart very rapidly, coming off the high of 1700. This month we rested at levels around 1260, 1275. I think that is the support that we can expect going forward. That's about 8.5% lower, and the next one is about 19% lower. So, you know, consumer discretionary, definitely plenty of downside risk. And obviously, when you look at the shorter term charts, you will see that there is plenty of upside resistance, which makes the risk reward ratio for this sector very unfavorable. We move over to staples. That's one of the better sectors. It's one of the defensive sectors, and you will see that they are popping up on the plus side, because I do think that here the rhythm of higher highs and higher lows is still intact. So for the consumer staples sector, I keep this at an uptrend. We've dropped back into the channel, which usually means that there is probably a little bit more downside to follow. But you know, relative to the rest of the sectors, relative to the market, that should be doable. I think the near-term risk is about 3% lower. As you can see that's the high that we've seen here in the middle of 2020. When was that? That was in August. And then the next level is around the bottom of the channel, and that coincides with the high that we've seen in November 2020. That's about 10%. So 3% the first, and then 10% the next level. We go to the energy sector. Obviously, that is the sector in favor right now. It continues to rise. It's the sector that is clearly in an uptrend. series of higher highs and higher lows is very, very present. You see that we've had this broad channel that was on my monthly chart for quite a while already. And I think the downside risk here is maybe even the diagonal line here, but more reliable is probably this high here, this cluster of highs here, and the one right here. And that is 12.5 to 16% lower. Decent downside risk, but you know, in the bigger scheme of things, you know, pretty good. I mean, the energy sector, on the back of what's happening in commodities, still doing very well. One of the few sectors that is maintaining its uptrend. If we go to financials, then I think that here the uptrend is also still intact. You can see that the previous low, in my view, is right here. That is mid-2021, around 575. You can see that we have, but this could be a new higher low. We're clustering around the area here, that's 614, 615, and right now we are at 640. That's the closing of the month of February. So that means that, you know, the first low that we can watch as support is around 9.5, 10% lower, and then all the way back to the breakout level that we witnessed early 2020. That's about 19% lower. But for the sector as such, the uptrend in price, remember everything we do with these monthly charts is for price, and that is still in an uptrend for the financial sector. If we go to healthcare, then again, this also is still in an uptrend. We're very close to breaking below this low, and you could argue that maybe, you know, in the month of February we did that because the low here, the low reading is 1447, and the low here is 1452. I'm not going to be that picky. I mean, I think that when we put in a low here and we bounce back up, I think that low here, that support has held up. So again, the series of higher highs and higher lows is intact. Well, I have to say it's not a lower low yet, not really a lower low. So that makes the downside risk for healthcare, if we maintain the area here, around 4% downside risk, and then the next level is around 8%. Healthcare, one of the defensive sectors, still holding up well. As you can see, we're still outside that old rising channel, so even if we drop below this 1450 low, then we're very close to bouncing off that 8.4, so that's the area around 1390, 1400, it's moving up a little bit. That's your next area of support. So the downside risk here, relatively limited, as to be expected from a defensive sector. If we go to industrials, that is a sector which, as you can see, has broken its uptrend. It was already sort of doing that. Kind of uncertain, lower low, new higher high. Now we are definitely at a lower low, so that uptrend is gone. Downside risk around 9.5% to the peak here at the end of 2020, and then all the way down 14.7, almost 15% down to area around 720. If we bounced back up, but the low of February is clearly in place. That was put in at 788, let's say 790. The uptrend is gone. Topish formation, and I think you will agree that this uptrend at least is in a pause. I mean, we haven't seen a lower high yet. That would be necessary to label it as a new downtrend. So we're not labeling it as a new downtrend. We're labeling it as the uptrend has stopped. So sort of neutral kind of thing, but not an uptrend anymore. And you can see it here in the thumbnail even more clearly. If we go to technology, and that's too bad, we have to conclude that the uptrend here is also gone. The low here was 2580, that was violated very clearly in February. We bounced back towards 2700. Question is how strong that bounce can be. The first support level that I'm watching is around 9% lower. That is towards 24.44. That's the high that you saw here. And then the next one is all the way down to 2200. That's the cluster of highs that we saw in August, September 2020. It's important because technology is an important sector and discretionary is an important sector, and both sectors have broken their uptrends. They're not in a downtrend yet, but they've broken their uptrend, so that at least they are moving sideways. That would be the good scenario. So please keep that in mind. A lot of the market capitalization is now not in an uptrend anymore. If we go to the materials sector, a similar story. Very recently we still made a new all-time high, but we bounced back and we're now threatening that support area just below 500. If you look at that here, that's 490. Obviously if that breaks, that would be bad news, but for the time being, that level, around 6% lower from current levels, is the first support level that we need to watch. And then I've labeled the next support level, that cluster here that we've had 3 months around 440 with lows coming in around 440. That's about 16% lower for the materials sector. This uptrend is still there. We don't have a lower low yet, so we've got to keep this at an uptrend formally. Does it look very, very strong? No, not really. But given, comparing to sectors that are clearly making new lower lows, it's one of the better ones probably. And then we go to real estate. Again, here also the uptrend is gone. We breached the previous low. Next level to watch, in my opinion, is around 8% lower. That's the high here around 260. And then very shortly after that, about 12% lower is around 1250, where you had that cluster of highs at the end of 2019. But here also the uptrend is gone. It's not a downtrend yet, but the uptrend has been violated, has stopped to exist. And then finally we have the utility sector. Here the uptrend is still there. It's not very strong, but we see the lows coming in at higher levels, so that is good. And the highs are also coming in at higher levels. So we still have that higher highs, higher lows rhythm, and that maintains an uptrend. And again, obviously utilities is one of the defensive sectors, so that is what you would expect in the current market circumstances. Wrapping that all up in our table, as we do it every month, gives us the following result. All sectors, including the S&P 500, have a negative return. The only sector with a positive return, as we've seen, is energy with a 6.4% gain. There were no new all-time highs, no new closing highs, not surprisingly, not for any sector, not for the market. In the uptrends, we have a few remaining. There are now more red crosses showing up. Staples, energy, financials, healthcare, materials and utilities are still in an uptrend, as we've seen on the charts. And if we add up all those weights, these are market capitalization weights, then we end up with 39% of the market still in an uptrend. That means that about 60% of the market is now not in an uptrend anymore. Doesn't mean it's in a downtrend, but it's not in an uptrend anymore. That's a very big difference. I mean, obviously it could turn into that, the market's going into a downtrend, but it has not done that yet. So we have to wait and see how that goes. But this is obviously the weakest table as I've presented it, probably since I started doing this, which is, I had to look it up, but it's probably more than a year ago. And here's all the downside risks as we've labeled them when we were going over the chart. So keep that in mind. Market is in general not in an uptrend anymore. The sectors that are still in uptrends are predominantly the defensive sectors. Added to that, financials, rates going higher, and energy, on the back of energy prices and commodity prices rising. So that's it. That's a wrap for the sector segment. When we switch to asset classes with our monthly charts, then obviously the first one to look at is the S&P 500. We've already done that when we were looking at the sectors, so I'm going to skip this chart for now because you've already seen it. Now, government bonds, interesting chart. We've already monitored this for a while. And remember, when I spoke about the sectors and I said these are stopped being uptrends because the rhythm of higher highs and higher lows is broken, but they're not downtrends because we don't have any lower highs in place yet. Look at these, this treasury bond ETF at the bond market. This is a very clear series of lower highs and lower lows, and it was recently confirmed already in January, and that followed through here in February with a very clear downtrend now in place for government bonds. If we narrow that, if we zoom in on the 7 to 10 year segment of the yield curve, we see a similar image, a similar picture. With that difference that 110 here is a support level which was tested during the month, and you see that it was a big bounce from 110 to 112, but now we've got the case where old support will return as resistance, and it will very likely do that for IEF and the bond market as well, which means that the bond market is in a downtrend. Government bond market is in a downtrend, pushing yields up. If we move to the corporate bond segment, then we also see a downtrend in place, very clearly lower highs, lower lows. Market is now bouncing, resting at a major support level that was the upper boundary of a range that was started back in 2012 and was tested three times, and then here we had a little hesitation before we broke higher in the summer of 2019. We're now testing that old resistance level as support, but the downtrend here for corporate bonds is very well visible. We move to the high yield segment. Not really a downtrend in play, but this one never managed to get out of the range with a very slowly down sloping resistance over the major highs since 2017. And I think we're on the way to a test of support of that lower boundary, which is roughly between 78 and 80. So in high yields, we also see prices trending lower within that broad range that's intact there. We've already seen real estate, so V&Q is not much different. The uptrend stopped to exist. It's not a downtrend yet. But then the two most interesting charts in this universe of asset classes are DJP and GSG, the both commodity ETFs that we're tracking. Look at how stable this trend is. And last month we broke above horizontal resistance, and this month we're breaking out of that rising channel, which is adding fuel to the rally. And if you look, want to guess where it's going, I think we are running into some sort of resistance here around 36. That's here, lows of June, maybe this one here, and then definitely here in December. But the uptrend is very much there and very much confirmed recently. And if you look at GSG, you got a similar picture, breaking important horizontal resistance last month. Good follow through now. Next stop very likely around 22.50, but the big turnaround that we've been monitoring here in Sector Spotlight for commodities is definitely in place, and it looks as if this is going to continue for at least a little while. And then the US dollar hesitating a little bit against that old support line now acting as resistance, but the double bottom here is complete, is in play, the follow through is in play, and it continues to creep higher, so it continues to see dollar strength. And we, as you remember, we noticed a little hesitation in the euro-dollar exchange rate as well. That seems to have resolved itself again to the downside. So that dollar strength image, dollar strength picture is still very much intact. And finally, if we look at the relationship between stocks and bonds, that got hurt as well, and you can see that we are You know, we put a new low here in place that the monthly low was lower. Here was the pivot low, so to say. There's another one if you look really closely here. So it's debatable whether this uptrend is still there, but I do think that this reversal and the long range bars indicate a lot of volatility, a lot of uncertainty. So my preference would be, well, at least neutral, but it's biased towards bonds. So stock market, quite careful with positions in the stock market right now vis-a-vis government bonds, because this is government bonds, beware. And that concludes Sector Spotlight for this week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope you enjoyed the show, and I'm looking forward to see you again next week at a new episode of Sector Spotlight. Same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.